In this example video, we will go over review exercise 811, where we're talking about how we apply dollar value LIFO under the retail inventory method. So they tell us that the Johnson Corporation had beginning inventory of $20,000 at cost and $35,000 at retail. During the year, it made net purchases of $180,000 at cost and $322,000 at retail. They made sales of $300,000, and they say, assuming a price index of 100 at the beginning of the year and 110 at the end of the year, compute their ending inventory at cost, again using dollar value LIFO under the retail method. So this really is a combination of dollar value LIFO and the retail method. So we're going to do both applications. So the first thing that we want to do is set up what we normally do under our retail method. So we have our cost values and our retail values. They told us our beginning inventory had a cost index of 100, and by the end, our cost index was 110. So before we can do anything, we're going to apply that dollar value LIFO. We are going to convert our ending inventory back to what the base year value would be in order to figure out if we have a real increase or a real decrease in our inventory. So our ending inventory at retail was $57,000, and we want to revert it back to our base year value. So 100% over 110. So our index at the beginning versus our index at the end tells us that our ending inventory at base year would be at $51,818. So that means we would really be able to compare our beginning inventory of $35,000 to our ending inventory at base year of $51,818 and know that now there is an in fact increase in our inventory. So we have to get our inventory change at the base year value. So we take our $51,818 ending inventory value at base year minus our $35,000 beginning inventory, which is also at base year. So that means we have a $16,818 increase, and again, that's at base year prices. So now that we've applied dollar value LIFO, now we're going to look at applying our cost to retail ratios under that retail inventory method. So because of that, because there is an inventory increase, we know that anytime there's an increase, we use the current index to revert it back to what it would be based on the information provided. So we had $16,818 increase, and we're going to revert it back to our current year index of 110. So that means we have a real increase in our inventory of 18,500 at our current year index. So now we can go ahead, and we know that because there's an increase and we're using LIFO under the retail inventory method, we know then that all of our beginning inventory is still there, and therefore we'd only have to apply the cost to retail ratio for the purchases to that additional increase, which in this case we just calculated as 18,500. So we know, looking at the information, that at retail, our beginning inventory was 35, and at cost, it was 20. So we know that we have all 20,000 of that, and then we have to add that layer. So we have our $18,500 in increase, and we're going to multiply that by our cost to retail ratio of 0.56. Meaning that our ending inventory at cost would be at $30,360. And again, our cost to retail ratio, we'd only have to calculate one for our purchases, would be the $180,000 at cost value for purchases divided by the $322,000 at our purchase retail value. There were no net markups or net markdowns, so we didn't have to factor that in. So that gave us that 0.56 cost to retail ratio for our purchases. So again, it's a combination of both LIFO, dollar value LIFO, and retail. And the first thing that we have to do is apply dollar value LIFO first. Revert back ending inventory to base year, determine if there was an increase or decrease at base year. If there's an increase, we apply the current index. If there was a decrease, we'd apply the base year index. And now once we know in this case that there's an increase, we can then apply the retail inventory.